Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Future Fuel Corp, ticker FF. There was a request. I had done a video on this stock last year. It looked to be incredibly undervalued, and definitely still does today. But there are some other factors that we need to take a look at. They did not live up to expectations. The fair value has come down. I believe last time it was about $12, now it's only $10, but the share price is $5. So I definitely see some upside to it. With our thesis, though, you're not getting a lot in terms of a return. The dividend is the saving grace here, as long as they maintain the dividend that they paid out this year. And even then, you're getting on the lower end of market returns. So fundamentally, everything looks super strong. You see all this green here. There's really no red aside from they issued some shares 3 years ago, and they have not issued since. So things are looking okay on that front. So as I said, getting right into it, we're looking to get into this with a decent margin of safety. That put us at about $7 a share or so. It hasn't even been that high in the last 52 weeks. This is definitely a smaller cap stock, so it doesn't get as much attention. It is held by a lot of insiders. Almost half the company is insiders, and the other half is institution. There's not a lot of retail in this stock, and the analyst ratings that it does have are buy ratings, at least. There are no sells from insiders. There are a few buys, nothing major. So no massive red flags on that front either. Earnings looks great. Clearly it's undervalued, 10% earnings yield. We love to see that. Cash flow yield was low this year. On average, they're around 18.6 though. So they need to fix those cash flows. Likely had some large expenses come up and not let that cash get all the way to the bottom line. Dividend yield, 4.5%. They did have a massive dividend back in 2020, almost $2.75 a share, which of course at the current share price is insane. And so that's why the average looks so high. They are a bit below where we'd like to see for our payout ratio. So their earnings are pretty high for the dividend that they pay. And they've got a bit of room to raise it, honestly. 28% off this year's earnings, 22% off next year's. We like to see that 30 to 50%. So I'd like to see them come in with a raise. Have not seen it historically, so we'll see. ROE, 12%, really good. Debt to equity, 0.18. So that is not skewed. That is one of the best debt to equities we've seen. So balance sheet is in good shape here. ROI, 9.6%. That's solid. ROA, 10.2. Those are all super good. Margins, 11% gross. So gross is a little low, but they still end up with 10% net. So as long as they're above 10% net, that's what we like to see. PE currently trading shy of 5 and price to earnings growth of 0.51. So everything is looking super solid fundamentally. Clearly undervalued and not a poorly run company. But revenue growth is clearly slowing down. They had some decent growth 3 years ago, and it's kind of just stagnant around 4% per year. So we're going to stick that for our thesis. Share count, we're going to say they keep it flat. They have for the last 2 years. We'd really not like them to issue more shares. Ideally, they buy some back with the strong cash flows. Their balance sheet's good enough. They don't need to issue shares. Assets, I'm just going with half of what they came in the last 2 years. 1% for asset growth, 2% for liabilities. They had been selling off their assets and buying back or paying off their liabilities. But over the last 2 years, we've seen small growth in both, with the assets outpacing liabilities 2x. Dividend, like I said, probably going to hold that flat, but we will see on that one. And then margins, they did come in a bit lower than what they have previously, so I'd like to see that go up at least a little bit. And honestly, they do have some more room to grow it. 0.3 only takes them to 10.3% in the next 5 years. So 0.5, that doesn't even take them to 10.5. Let's take them to 0.75 then. That's looking a lot better. So buying at today's price, you're getting some great market outperformance. In 5 years, based on this thesis, the fair value of the stock is around $14. And you're making, if this is how things go, then they're growing about 3% per year. Once you factor in that dividend of 4.6%, you're talking almost 8% now that we adjusted those margins. No, if they can get the revenues up a little bit higher, it'd be even better. And really, there's only one other thing to look at here, because this stock is super undervalued, but it's been on the decline since 2020. Every metric fell from 2020 to about 2022, leveled off, and some of them are starting to show some growth. And that's really what you're banking on if you're buying in right now, is that the declines are over with. It's going to be stagnant where it's at, in which case, hopefully the market realizes the valuation and it doubles, or it continues to grow, ideally faster than this. I mean, if they can get something more in line with what they have in the last 2 years, 4.5%, and then get their margins back up to around 11%, like we've seen them do historically. 2% annual growth, what we've seen historically out of them. Gets you up to almost 4% returns. 8.6 once you factor in the dividend. Let's say they do come back and start growing this dividend again. I mean, if they can get back to where they were in 2020, that'd be incredible. But that would be a very good scenario here. So I really don't have much to complain about here. All that I can really complain about is the low annual growth, because thesis is not too pretty. I mean, maybe we can have the cash flows outpacing the revenue growth to get a better cash flow yield, since they did have really high yields. To get their cash flow yield back up to 10%, where we really like to see it, that'd be 25% annualized growth. And in that case, this stock would be an obvious buy. You'd be getting almost 11% off of growth, and then once you factor in that dividend, you're talking 15.5%. So very solid. At least it's a cheap stock. It's not a bad idea to get some exposure to it, because it does seem to have some potential, especially if they can break this flatness in their revenue growth. And personally, once I did the analysis here, I went into Robinhood and I sold a $5 put for $5. So if I get assigned, it's 1 share for free. I'll sit on 100 shares, only $500 in exposure. That's not too bad. And it looks like I can probably sell a covered call once a month at the 750 strike for ideally $5 or more, from what it was looking like. So it'd take a lot of time to get money back that way, but if it's able to run up to that point and I get assigned on that covered call, I'd be more than happy. I'd get $250 plus whatever I make off the options premiums. So that's how I'm playing this one. I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. I'll catch you next time.